Meanwhile, financial expert Kelvin Sanga says the decision by the central bank to maintain the monetary policy rate at 9.0% will help the economy to fully recover. He told Millennium TV News in an interview that raising the policy rate would have had negative impacts on the economy, as it would have suffocated the credit market for businesses. Mr. Sanga noted that lowering the policy rate would have resulted in difficulties in bringing down the inflation towards the target range of 6 to 8%. He adds that the headline inflation had continued to linger just slightly above the underband of the medium-term target of 6 to 8%. Mr. Sanga further explains that the policy rate has shown some relatively positive signs of making heavy marks on the economic front.
From the microeconomic perspectives, more especially on the inflation development, has really triggered us to see the Bank of Zambia stay its course in the monetary policy rate at 9%, mainly because there's been some good effect that we're able to see, as we can attest to say that the necessity to make the policy rate staying at this level is basically help to fully recover the economic growth that we're able to project or able to see, of which it hinges also on the benchmark to actually work out with the lending rate, as well as other key fundamentals that go by the policy rate. The change that we have actually been recording or seeing from the last previous monetary policy rate has also really compounded some of these factors that we're able to see. On top of the thing that we have actually been seeing, that the intermarket in terms of performance has really shown some good effects. The trade patterns also, although there has been some few elements that we could actually be able to see from the levels of participation, where the production in terms of output for last month was quite poor. And even just the other compounding factors to do with the export market also has really correlated to all the conclusion of what we're able to see. But obviously we have got issues to say that if the monetary policy was to be raised, it could have meant that the bank would have suffocated the market for liquidity in the